This is Matthew Cratter from Trade University, and today I want to talk a little bit about why stocks have been crashing. If you've just been sticking to the major stock indices like the S&P 500 or the triple Qs, you haven't seen that much damage. They've been holding up fairly well. But meanwhile, there's a breadth problem going on, which means that a lot of stocks are hitting new 52-week lows at the same time that the indices are near highs. So if you've been hiding out in the indices, this has not looked like a stock market crash. But if you've been in a lot of the momentum names, and all of Trader University subscribers got out of their momentum names, we had an alert a couple weeks back. But if you didn't get out, this is what a lot of these momentum stocks look like. They're just straight down. And I want to talk a little bit about the reasons for that. Bloomberg itself has recognized that there is this breadth problem going on, and it's quite likely that it begins to spread to the indices as well, that SPY and QQQ head down from here. And I want to go into the reasons for this. The U.S. has this little economic problem. If we take a look at the red line here, the red line is all of the debt. The blue line is GDP, which is a measurement of all the goods and services that the U.S. economy produces. And the problem with this is you need to tax the blue line in order to pay interest on the red line, or you somehow have to harvest the blue line, which is the hard work of all of us, to pay, not just pay back the principal, but also service the interest on all of this debt. And we can see how these have been diverging, especially since 1971, when the U.S. went off of the gold standard. And this is a problem, especially when your debt is growing at a faster rate than the economy is. And we can see that the red line is steeper. Debt has been growing at a faster rate. So this is the major problem. The government needs to tax the little blue line in order to pay interest on the red line. Debt is growing much faster than the economy itself. So what do you do if you're a central banker? Well, barring some miraculous productivity miracle, like the overnight invention of nuclear fusion or teleportation, like on Star Trek, something like this, you actually need to inflate your way out of this mess. That's the only way to get out of this debt mess. And what that means for the government is this little trick where it prints money with its left hand and uses it to pay its right hand. This is what we mean when the Fed is monetizing the deficit spending. Now, in the process, the Fed is doing this in order to get debt levels back to where they were in the late 1970s so that they can raise interest rates back up. I hear a lot of people saying we need Paul Volcker here to raise interest rates and slow things down, get rid of these bubbles, and prop up the currency like he did in the early 80s. But the problem is when the economy is as levered as it is, you cannot do that. You could bring back Paul Volcker from the dead, and he would not be able to do the Volcker thing. So this is back in 1980 when Paul Volcker was raising interest rates. Debt to GDP, which is what this is a chart of, total public debt divided by GDP, so normalized for GDP, normalized for the size of the economy. And again, this is important because it's the real economy that gets taxed in order to pay off debt. But back in the 80s when Paul Volcker was raising interest rates, the debt to GDP levels for the U.S. were around 30%. Right now, they're around 100 and call it 122, 123%. Now we have over the last year or so brought these debt levels back down. We can see that they really peaked in the second quarter of 2020, which is when the pandemic started. And since then, the government, the Fed, has been printing huge amounts of money. And this has brought down, it's stimulated GDP growth, and it's helped to lower this ratio. So we've gone from about 135% debt to GDP down to 122%. Now we have a long way to go, obviously, but what has this done? Just moving down these 12 points or so has caused a lot of problems. It's been great if you own a house or if you own stocks, but unfortunately, this is unsustainable for the general economy. It's especially difficult for renters who have a variable rent that can be raised. If you have a house, you probably have a fixed mortgage payments. But if you're a renter, especially if you don't own assets like houses or stocks, it's been a very difficult time. The PPI, which is the Producer Price Index, one measurement of inflation, is up 9.6%. The CPI hitting the highest levels of growth since the 1970s and 1980s. And this is even after the CPI has been massaged to make it lower than it otherwise should be. So printing money is great for bringing down this debt to GDP levels, but it causes a lot of problems, especially causes problems at the grocery store and at the gas pumps. And this has political effects, as we're going to see. But if you're finding this video helpful so far, if you could just hit that subscribe button, hit the like button, share this video with a few friends. I'm finding that a lot of people who watch my videos aren't actually subscribed. So if you're one of those, please hit the subscribe button and help to support the channel this way. So printing money drives up a lot of things like housing prices and stock prices, which is great, but it also drives up grocery prices and fuel prices. And this causes political headaches for incumbents. And so we've had a situation that's something like this over the past couple months. We had President Joe Biden renominate Jay Powell for another term, for a second term at the Federal Reserve, and say basically, I'm going to assume this is what happened in maybe using body language or a secret code. Okay, Jay, I renominate you for a second term. Now, can you please make gas prices go down? The Fed has become extremely politicized over the past 20 years, and certainly over the past, call it 5 years. And so this is really how it's working. The Fed is working in much more coordinated fashion with the Treasury and with the executive branch. So Jay Powell turns off the money printer, which means a lot of things. It means, hopefully, for those who buy a lot of gas for their gas tanks, it means lower gas prices. But it also means no more fun meme stocks. We can see what's happened to stocks like AMC that were more a function, not just pump and dumps by retail investors, but also a function of liquidity in the system provided by the Fed. We can see the underperformance of Cathie Wood's funds, ARKK, doing very, very poorly, and her whole company is under a lot of pressure for this. But what she was really doing, she was a very smart stock picker, but mostly what she was doing was riding the Fed liquidity wave. No more money printer also means lower stock and housing prices. Now, this doesn't happen overnight, but we can see it already happening, as we said, with deteriorating breadth in the stock market. When you get lower stock and housing prices, this is very bad for capital gains taxes for the government. They collect lower tax receipts, and it also lowers consumer spending because consumers don't feel quite as flush when their stock portfolio is down. And it's very strange for stocks to be down at this time of year. This is normally seasonally a very bullish time of the year, the fourth quarter of the year. So this just shows how the effects of turning off the money printer and how that cannot even overcome, or how that overcomes seasonal effects. So when you have lower tax receipts and lower consumer spending, what it means is GDP shrinks. As we said, tax revenue shrinks. Right now it's at about 4 trillion, but the government's spending about 7 trillion. So they have to borrow the difference, which is about, right now is about 2.8, 2.9 trillion. That's the deficit spending, and they need to issue debt in order to pay for that. So when you have lower tax receipts, when you have lower consumer spending, the government has to borrow even more money to make up for the falling tax receipts. Now, when the government borrows more money, obviously that means that it grows the pile of government debt. And now we're back where we started. We're back to high debt levels and high debt to GDP levels because the debt piece, the numerator is growing while the economy, GDP, is shrinking as the Fed turns more hawkish. When I was a kid, I really loved these choose your own adventure books. I'm probably dating myself here, but I would propose that the Fed is playing their own choose your own adventure book. And the point of this book is a little bit like various TV shows where you get to press and decide what the protagonist does next. So there are many different paths and many different endings through the book. I'm calling this Choose Your Own Adventure, Volume 69, Central Banker Game Time. And so they have a choice at this point in the story. Do they taper aggressively, raise interest rates, and crash the stock market and housing market? That's what we're seeing right now. We're seeing the Fed up its taper and move it to a more aggressive schedule. Or do they let inflation run hot, destroy the US dollar, kill the working and middle classes with astronomical grocery bills and gas prices? These really, unfortunately, are the two choices. So what Jay Powell's been doing, like most very political people, he's been unwilling to make a firm decision. So he says, let's just do both. We'll first stomp on the brakes, which is what they're doing right now, and then we'll punch the gas pedal again. And what this means is if you're riding in the car with Jay Powell, it's going to be a very bumpy ride indeed. And this is what he's been doing. So right now the Fed has its foot on the brake. It's turned more hawkish. It's accelerating the taper. But when stocks start to really fall, and here's the key, especially when the U.S. Treasury market starts to crack, and we see a couple days where stocks are falling in tandem with government bonds, with U.S. Treasuries, that's when Powell will have to move his foot back on to the gas pedal. But I don't think that really happens until we see Treasuries start to sell off. And so Powell's in this very strange situation where he has to pick between the brake and the gas pedal. And he's sort of damned if he does and damned if he doesn't. Nothing else really matters anymore, especially for stock market analysis, even for cryptocurrencies. Financial statement analysis is dead. Value investing is dead. Economic cycle theory is dead. Everything is dead except for these zombie central bankers prowling the earth and flipping the economy on and off with almost as if they have a switch. And right now they flipped the off switch, which is why everything is selling off. The economy is so levered now. You can really see it well in this chart of Fed funds, which is the interest rate that's set by the Fed. And this chart really is a series of lower highs and lower lows. And what this shows is that the economy can no longer, because of the very high debt levels and the amount of leverage in the system, the economy can no longer withstand higher interest rates. So the peak of the hawkish cycle has been lower each time. So they hiked to about 6% in 2000. In 2007, they tried to hike, but they only got up to about 5%, and then the housing market blew up. And in this most recent recovery, they've hiked almost, they were only able to hike to about 2.5%, and now we're back down really to zero. So I imagine at this point, the Fed will try to hike, will go from 25 basis points to 50 or 75 basis points. At some point, something is going to break. Stocks and treasuries are going to crash. And we may not get to that point. Maybe the Fed takes its foot off the brake before that. But it seems likely that they will at least hike until the treasury market breaks. And so we can expect more weakness for now from the Fed. The interest rates no longer work, or they work they work to slow the economy when you raise them, but they no longer provide stimulus when you cut them. And this is the problem. It's sort of an asymmetric problem that the Fed has here, which is one reason they've had to resort to growing their balance sheet, printing more money, buying assets, and putting it on their balance sheet. So this is what we mean by the taper. We mean that they're going to slow the rate of purchases until they're no longer buying any treasuries or mortgage-backed securities every month, or if something blows up first. So here we have the Federal Reserve Committee, the zombies. They're meeting today to decide what to do. What do I think is going to happen? Today, I think the Fed is almost certainly going to announce a faster taper. They're not going to raise interest rates today, but they are going to accelerate the timeline for the taper. In other words, they're going to cut back more quickly on how many treasuries and mortgage backs they're buying every month. As a result, this has become a very difficult trading environment, especially as we head into the holidays and liquidity goes down in terms of trading volume. The market could get even more choppy, and the Santa Claus rally this year could be very, very short or non-existent, simply because the Fed wields so much influence here. So expect more volatility and chop. But the good news is that the only long-term way out is hyperinflationary. The Fed needs to get back to the money printers. After things crash for a while, they are going to turn the money printers back on, and they're going to have to turn them on at an even higher rate than they did before, simply because there's no one else to buy all this government debt. Foreign buyers, foreign central banks don't want to own it because both nominal and real interest rates are so low. In fact, real interest rates are quite negative because of where inflation is. And so the Fed is going to have to continue to be the buyer of last resort. And the way you can think about it is this: the U.S. government can't spend. The U.S. government cannot stop spending. Therefore, the Fed cannot stop buying treasuries. Therefore, asset prices to the moon, stonks to the moon, houses to the moon, Bitcoin to the moon. So I would be using this opportunity, and I am, to scoop up more cheap Bitcoin. Get ready, do some studying. Momentum stocks will be back before we know it. We just have to let this play out, and the gas pedal is definitely coming back soon. The stock market and maybe even the housing market is going to make Jerome Powell call uncle. He's going to panic. He's going to rev up the money printers again, and then we'll be off to the races. This is sort of what the end of the debt cycle looks like. It's going to be choppy, it's going to be volatile, but ultimately it's going to be very, very good for assets like stocks, houses, and Bitcoin. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.